into it. All right, it's official.
Bye.
We're recording. And thank you guys for joining. We got people from, Colorado, Brazil, and a car on the Ohio Turnpike, not to mention a few other places around the world.
Rachel, that is not safe.
Yeah, I hope you're just listening. You don't feel like you need to watch us. Even though Pino looks really nice. I'm just in a sweatshirt, but Pino's looking great today. And thanks for joining. This is our 40th ever knowledge drop. We're filling up, man. There's a lot of people interested in this topic. And yeah, we're going to get into it in a second about taxes as a person from the US, but someone who's traveling the world and all the implications of that. And if you haven't been to a knowledge drop in a while, or this is just your first one, you guys are already figuring out the chat box. So continue to chat and tell us, or tell Pino how good she looks today. I'm still waking up. So you can add whatever chats you want into the chat box there. And then there's also a question and answer box. So if you have questions that come to mind as Pino's going through a slide deck, feel free to put those in there and we'll get back to those at the end of the half an hour. Hopefully we'll have plenty of time for all of your questions when it comes to this subject. And also, as I was just saying when we got started, we are recording this. So this will end up on our knowledge drop blog archive in the future, so you can always rewatch this, or say you have a younger sibling or a friend that starts traveling a bunch and they're like, hey, what about taxes? You'll always have this little link that you can send over to them and they can learn from the lovely Krystal Pino. So with all of that out of the way, let me pass it over to you. Thanks again for doing this, Pino. I know we had it planned and we pushed it back a bit, but you're the most friendly, most helpful, most flexible person, so thank you so much for doing this.
Yeah, no worries. Extra time to prepare never hurt anybody. So, all right. Well, like Travis said, we're going to go ahead and I'm going to present this information to you in kind of a little bit of a quick fashion, just so that we have plenty of time for questions at the end, because I know you guys are going to have them. So let me just go ahead and get some share screen action going on. And, mode. I'm going to go to present. All right. There we go.
Perfect.
All right, while we're loading, sorry about this.
Also, where are you right now? Your background is just amazing. Is that somewhere downtown Cape Town?
Yeah, well, this is actually the terrace on my apartment in Cape Town. It's the whole reason that I got this place, because you have the lovely Table Mountain in the background. So wow, I was actually trying to decide where to do. Yeah, I was trying to decide where to do this knowledge drop from. My roommate was like, you have to do it from the terrace. So I was like, oh, okay, cool. So, all right. Well, we're going to be knowledge dropping taxes with Table Mountain in the background. So this is pretty much going to be talking about what it means kind of when you're a digital nomad and what kind of effects does that have on your taxes. So what's about to drop? First of all, we're going to talk about the basic premise behind the foreign earned income exclusion. Most of you that have been traveling have probably heard about this kicked around. Your fellow nation people talked about it. So we're just going to kind of go over a quick overview, explain what it is and why you need to be thinking about it. We'll talk about what you can and can't deduct from your remote year expenses. And then at the end, we'll get a little bit into how, you're out there. I know you guys are all out there. You all have wonderful ideas. You want to start up businesses and do stuff like that. So talk about how you can structure your business to kind of meet your goals going forward. Unfortunately, this is a US only webinar because that is the only knowledge that I have. Down here, we have the loved and Christian Walther, patriotic expert, Kairos extraordinaire. If you don't know him, I highly suggest you meet this kid somewhere along the road. He's one of my favorites. He was in Chef's program, right, Kairos? Yeah.
Yeah, and I think this picture was from when he was ranked, if I'm not wrong, I think he was ranked number 10 and 11 of the most patriotic things on some list on BuzzFeed or something. It's just,
yeah, it's amazing. Yeah. So, okay. So Christian, it might be patriotic, but I am qualified to talk about tax. And why is that? I'm a CPA with a PFS, DA in accounting, and an MBA in international finance. And all of those letters basically mean that I'm a huge numbers nerd. I've got 5 years experience in corporate accounting, 3 years in public accounting, and 5 years kind of running my own side gig. But recently I decided to go off on my own. So I'm an entrepreneur and digital nomad myself. So I learned all these things for myself, and you can apply them to you. But first, we're going to talk about some legal stuff. Like it's saying, all of this stuff that we're going to talk about here doesn't constitute any specific advice for anybody, and it's really not backed up by me, my company, or remote year. It's a high-level summary. It's not meant to kind of pertain to individual levels, so always just kind of talk to somebody about your particular facts and circumstances. So, legal is not my favorite, but tax is. So let's talk about the foreign earned income exclusion. What exactly is it? The foreign earned income exclusion allows for an exemption of U.S. earned income from federal income taxes if certain requirements are met. As far as the state's concerned, the regulations vary from state to state. Some states do have a reciprocal agreement where they allow this as well. But I think the most important thing to note is that it does not apply to your Social Security and Medicare, which is your self-employment taxes. So if you're self-employed, you will kind of have, this doesn't apply to them. Why do you care about the foreign earned income exclusion? Because it saves you, it could potentially save you a lot of money. Kind of two examples that we have here. So if you look at kind of the mid-range, $50,000 a year salary, for 2018, you're in the 22% tax bracket. If you qualify for the foreign earned income exclusion, your savings can be up to $11,000 based on $50,000 a year salary. And the exclusion for this year tops out at $104,100. That puts you in a 24% tax rate bracket. And look at that, $24,985. That will almost pay for a remote year. If not, it's one baller ass side trip, right? So it's definitely something that you need to be aware of and thinking about if you are traveling long term. So how does it work? There are two tests there's some tests that you have to pass in order to qualify for the foreign earned income exclusion. First one is the bona fide residence test. These are people who straight up leave the United States. I'm moving, I'm going somewhere else. I want to live in Costa Rica. I want to live in Thailand. They set up residence somewhere else. They live there. That's not going to be most of you guys. Might be some of you, but not most of you. Most of us qualify under what's called the physical presence test. And that's to say, you know what? We're out of the U.S. We were out of the U.S. long enough to say that, we qualify for this. What is the physical presence test? It can get a little complicated. And basically it's because you have to spend more than 330 out of 365 rolling days outside of the U.S. And what I mean by rolling is it doesn't have to be a calendar year. It can be any 365-day period where you were gone more than 330 days. If you weren't gone more than 330 days, then you're not going to qualify. So stop here, do not pass go, do not collect $200, go straight to paying your regular taxes. If you were outside of the United States, then you might qualify. So we dive in deeper and we ask some more questions. Step two of kind of the foreign earned income exclusion is the establishment of the tax home. And it's important to note that this is your business home or your work home, not your personal home. The question matrix that I kind of like to take people through is, do you have a permanent office? If the answer is yes, it doesn't automatically disqualify you. Let me just kind of look at the nature of what your remote relationship is. Does your employer expect you back after this year? Or are you going to be able to continue working remote, maybe even on a part-time basis, anything like that? And those are the things that we can look at. And, but if that's not the case, like if your employer is like, nope, I gave you 365 days, day 366, I need you back here, I need your ass back in your office chair, and that's it, you're probably not going to qualify. The way that we like to talk about the foreign earned income exclusion is we say you either have a weak case for it or a strong case for it. So in this case, the little matrix I just kind of took you through, you're going to have a very weak case for the IRS. You're going to have a hard time proving to them that, it was for the benefit of your employer and it wasn't just a little hiatus and then you're going to be back. However, if you do kind of have this remote component, or you never had a permanent office, you always worked remote, you're self-employed, which means your office is where you are, then you're going to have what we call a stronger case. And this is when I recommend that you contact a tax professional. Doesn't have to be me, doesn't have to be, somebody, but somebody that knows a little bit about the FEIE, just kind of toss your facts out to them and see if they spit back to you. I say talk to a tax professional because this is the form that you need to fill out to qualify for the FEIE. You want to fill this out? I don't even want to fill this out, okay? I have software that helps me fill this out. But I know what each line means, but it's a long and it's a difficult form. It's got a lot of ins and outs to it, especially if you're not gone like within a calendar year. There's a lot of formulas that need to be applied. So just take that into account when you're kind of going through this on your own. Next, we'll kind of talk about deductions. Deductions are the amounts that the IRS lets you subtract from your income, and less income means less taxes. When people ask me, well, what can I deduct? You can deduct anything. You really seriously can deduct anything that you want. The question is it going to hold up on audit? Probably not. Well, some things are not going to. So my favorite tax answer to most questions that people ask me about tax is that it depends. If you're a W-2 taxpayer, meaning you have a job, your employer cuts you a check, they withhold taxes on your end, and then you just file a return at the end of the year, you got a lot less options than those of us that are 1099 employees or own our own businesses. You get the standard or the itemized deductions. That doesn't mean there's nothing, but you're much more limited. Self-employed people who are paid on 1099, people who are contractors, they have their Schedule Cs or Schedule Es. You can deduct any business-related expenses that aren't considered personal and are considered ordinary and necessary for your business. So what does that mean for RY? Once again, it depends, right? Every one of us can deduct 100% of the workspace. That's the thing for everybody, no matter what business that you're in. Depending on the nature of your business and what you're doing while on remote year, means that you could deduct a portion of your travel and you could deduct a portion of your living space. The issue with this is that right now, remote year is not offering an itemized bill that itemizes out travel versus living space. So what you kind of got to do is you kind of have to determine, okay, how much of remote year can I justifiably say goes along with my business? Now, me personally, last tax year, as I'm traveling and I'm meeting more remotes, I mean, like, this is my business. I do taxes for remote. So when I meet people and they ask me questions about taxes and they eventually become clients, I'm growing my business, right? So I can honestly say a portion of remote year, the travel and all of it, is a business expense for me. I think last year I settled on something like 30% though, because it was largely personal too. Like I said, the IRS won't let you deduct anything personal. I take the position that you're going to have a really hard time convincing the IRS that remote year was 100% business for you if you didn't get anything personal out of it. But once again, it's just going to be a conversation that you need to have with your tax professional and find something that you're comfortable kind of settling on between the two. Things that you can't deduct, I'll hammer this again. Anything considered a personal expense, not deductible in any way, shape, or form. Biggest one is clothing. You can't deduct fines and penalties, political contributions, illegal activities, club dues, country clubs, commuting to and from work. However, a secondary location is deductible. And then you can't deduct gifts in excess of $25 per recipient per year. So let's talk about getting audited. What are some of the risks, the top things that are going to get you audited? First of all, not reporting all of your income. Every tax document that you get saying somebody gave you money, the IRS gets a copy of that as well. So make sure that you're reporting everything that you get. Something interesting to note here is not receiving those documents is not a defense for not filing. Owning a business automatically puts you on the audit risk train. It's not a big one, but it does kind of, the IRS scrutinizes it a little bit more, especially if you're claiming what they call excessive business expenses. And the ones they look at them most closely are travels and meals and entertainment. So that's why it's kind of important to make sure that you're taking the right deductions on that one. Claiming a loss on your business, especially consecutive years in a row, will put you on the IRS's radar. Claiming the home office deduction, so not so much anymore. They come up with a new formula. It's a lot less. And then claiming the foreign earned income exclusion is an audit flag. Currently, their IRS areas of focus is filers with minimum ties to foreign countries that work in but keep abodes in the U.S., i.e. you guys who have homes. Doesn't automatically disqualify you, but it needs to look at the nature of what owning that home is. These are all just kind of talking points that you want to have if this is your situation. Now we get to the kind of thing. I don't mean to insult anybody, and there could be people on this call who do make more than $200,000 a year, but if you don't, then the IRS considers you small potatoes. 1% of filers recommend, 1% of audits each year are filers with less than $200,000 a year income. If you do get audited and they say that you don't qualify for the FEIE, you're going to be subject to a penalty, which is 5% unpaid taxes per month up to 25%. And interest, which is the federal short-term rate, plus 3%. So they're not going to put you in jail. The IRS doesn't put people in jail. They're just going to make you give the money back, and they're going to charge you some interest and penalties that go along with that. That's it. Pay it back. Next, we're going to touch on the business structures. So those of you who are out there and interested in starting your own business. There's 5 main business structures out there right now that you kind of need to think about. There are some more, but these are kind of the classic ones. I know Travis told me about one, and I didn't have time to look into it. But if anybody's interested in that one, we can definitely have a chat. So the main ones are your sole proprietor, LLC, partnership, S Corp, and C Corporation. The question is looking at which one is right for me. The sole proprietor, you can see that the first 4 are taxed at a personal level, and C Corp is the only one that's taxed at a company level. The sole proprietorship is the simplest form. This is just you get your 1099s, you file your 1099s, and that's it. Disadvantage to this one is that there's no liability protection for you, and you're still subject to those self-employment taxes. Next step up from that would be, say you want to form an LLC. LLCs are relatively simple to set up in each state, about $150 filing fee, about $100 fee per year to keep it up. You do get that liability protection that I was talking about, but you're still subject to those self-employment taxes. Partnerships are not as common anymore. I find that they're kind of a niche structure for a certain subset of businesses. You see a lot of family partnerships kind of go in this way. You're allowed to have unlimited partners. This would be a good one to look at if you're looking to partner with somebody who's not a U.S. citizen. The disadvantage of this is that partners do not have limited liability. So I would definitely recommend speaking with kind of a corporate structure attorney if that's the way you're looking to go. S Corp is a hybrid between a C Corp and an LLC. You're basically an LLC electing to be taxed as a corporation. This means that as an owner, you can share the burden of the self-employment taxes with the company. The downside of this is you're going to be subject to additional filing requirements, including the S Corp needs to file its own tax returns, and generally owners are paid on a W-2, which means that you'll be subject to payroll tax filings as well. The C Corp is your big old traditional corporation. It used to be a huge disadvantage because of the corporate tax rates. However, they seem to be coming down a lot. So this is a good structure to look into if you're looking to bring on investors later or shareholders, something like that. You can split the income and self-employment taxes with the company. Another one of the disadvantages of this is have a lot of annual obligations. You got to hold meetings, you have to take minutes, you have to file a bunch of forms every year. So it's a little more cumbersome and burdensome. But now here's a little chart. I'm not going to go through this one, but you guys can come back to this later and take a look at it. You can see kind of some of the advantages and disadvantages of each. So kind of takeaways and homework for this. If you do think that you're going to qualify for the FEIE, I recommend keeping a travel calendar. Just set one up in your Google Calendars or whatever calendar it is that you're using, and keep track of your calendar because if you ever do get audited, that's what they're going to look at if you're doing some travel. If you think you're going to qualify, talk to a professional. Just have a conversation with somebody. Sure, somebody in your network, me included, will be happy to sit down with you and have a 20-minute chat about it. For your deductions, make sure you keep records and make sure that you're able to justify those expenses if the IRS ever does come back and say, hey, we don't think this is deductible. Make sure you have good reasoning behind the reason that you think it is. Business structures, I think the biggest thing is just consider the long-term goals for your business, and then have a chat with a professional about what kind of the best way is going forward for you now, and considering those long-term goals. How am I doing? Do we have time for questions? Oh, we do have time for questions. Yay.
Well done. And yeah, this is all Pino's contact information. I'm assuming you're cool with people reaching out if they have follow-up questions after or whatever.
Absolutely. I mean, I know that most of you have probably seen me trolling on Slack. I mean, I creep in your channels. I'm in the Pat Taxes channels. I actually just started an RY specific tax channel too. And then just feel free. I mean, you can reach out to me on Slack in any way possible. I'm always happy to answer any questions.
Cool. And speaking of questions, we actually already have a bunch that came through. So why don't we pop off of your screen share and we'll just go back to us hanging out. Just our little faces here and start doing some of these hot cues that the audience has. First one, actually, I think that came in during, you were on the deductions slide and somebody asked if having a storage container. Yeah, it was Cosette was asking, what about keeping a storage unit? Is that something that you can deduct?
What's in the storage unit, I think would be my question. Yeah. Like if you're keeping your business records and stuff like that in it, then I would say yes. If it's, I mean, yeah, business records, furniture and stuff like that, yes. But I mean, if it's mainly full of like the clothes that don't fit in your 23 kg suitcase, probably not. I mean, and that might be another case where it's a percentage, you know, it's 30% of your business stuff, 70% of your personal.
Awesome. And before you guys keep asking more questions, please use the Q&A box. I'll try to get to the ones in the chat box, but they're really easy to get lost. And in the question and answer box, they stay organized a little better. And there's a lot of questions. So let me try this one. All right. Is there a way to become a resident of a different state for tax purposes in the next year? For example, California doesn't allow for FEIE on state income. So I think this is Marissa. She's wondering if she can, apply to get taxed as a Floridian or something.
Yeah, and this is a big question that a lot of you ask. And the thing that I always tell people is it's easier to change your residency in the States than on the road. It's almost impossible once you've left. There are 7 criteria that states look at when they consider residency. The biggest is address, car registration, voter registration. I have a list somewhere, and you can definitely reach out to me about these things. Another thing to look at is like the duration of your travel. I had a conversation with a guy earlier today. California has a safe harbor provision, which says if you're gone, it's 500 and some change days, then all of a sudden you're not considered a resident anymore. So the restrictions, they vary from state to state so much that it will be hard to give you a straight answer on this line. I would say, like I said, there are the 7 things that people look at, and it's easier to change while you're still in the States. It's nearly impossible once you're out, but it can be done.
Awesome. I'm going to pop over the question and answer box in a second, but Heather's in here in the chat box asking, you need to live 330 days out of 365 days, correct? And yes, I can't even answer that one because Pino's been so thorough going over it with me. But yeah, basically any rolling period of 365 days, if you're gone for over 330, you qualify in terms of that one test of like permanent, like where you are, physical presence test.
And then, the one that I like to tell about this one is like my 12-year-old nephew, every time I talk to him, keeps asking me why I can't come home for Christmas. And like, I definitely can't explain to him it's because I've already spent 35 days in the States this year. So he's so sad. I obviously doesn't get it, but I'm like, you don't understand. It'll cost me thousands of dollars and I just can't.
Yeah, it makes a huge difference ultimately, like the kickback. All right, we got a bunch in the question and answer box now that we'll try to get through. And I'm glad, we have enough time here to hopefully get through all these. So Nicole is asking, what's up, Nicole? She's saying, if we have a permanent address in the U.S. but don't own the home, is that considered an abode in the U.S.?
No.
Yeah. Yeah, because I think that's like
no. Abode, they're talking about property.
Yeah. Okay. Yeah. Perfect. Paula, since the ROI invoices are not itemized, is there a rule of thumb on how much the monthly fee is for the cost of the workspace?
Workspace, yes. They will tell you, that Remote Year has taken the position that $300 a month is for workspace. And you actually can get an itemized receipt from Remote Year that says $300 a month is workspace, $1,700 is for the rest. Now, the rest is the rest. So.
Nice. And then that kind of actually goes into this question. Travis is asking, if you run your own business / you're an independent contractor, can you deduct your Airbnb or accommodation expenses because it is technically your office? You kind of got into this a little bit, but I guess just to clarify your stance there.
Yeah. And you're going to get it. And the thing about tax and income tax is a lot of subjective. It's kind of like this. If you don't like mom's answer, you can go to dad. I take the position that, once again, we're going to call it a percentage. You're never going to tell the IRS that your Airbnb was 100% for work. Now, I mean, if you traveled specifically to that location to go to a client meeting, then you're going to say, okay, well then, that it's like your hotel, right? If you travel to go to a conference or you travel to go to a business meeting, then your hotel is 100% deductible, but if you're living somewhere for a month and you're not there specifically for business, like, how much was personal, how much was business?
Yeah. I dream in business, so I think I'd count those hours and, it becomes like a weird calculation, I guess. And then back to the storage unit thing, actually, Cosette was clarifying. She's actually wondering if you deduct the storage unit, does that put you at higher risk? Have you heard of that happening? Or?
I wouldn't say it puts you at higher risk. Like things like that aren't going to put you at higher risk. They are going to look at, so businesses form, you have, it's on an NAICS code, and the IRS, what they looked at is what is the pattern of expenses for that business code. And so say like you claim your rent and it's exorbitantly high for your business that, you know, makes widgets, you know, to say like you claim more rent than most people do, that's going to raise a flag with the IRS. But I mean, they're not looking at your individual expenses otherwise. However, if you were to get audited, it would be something that they look at.
Interesting. Also, this one is really interesting. Rico's asking, and this is something that like my brain can't quite figure out either. So I hope you have like a way to help us think about this. But how does the rolling FEIE work across calendar years? So if filing 2018 taxes, do I have to have been out of the country for 330 days of 2018? But then, yeah, like my thought too then is like, so then what if you're home for 3 months and then you leave again for over 330 out of 365 days? You wouldn't be able to qualify for 2018 and 2019, right? You'd have to wait and use that 330-day block for 2020, or I don't know. I'll let you try to, because it gets weird in my brain where I'm like, how would that work?
It gets weird in everybody's brain. It even gets weird in mine, which is why personally I'm like, I'm resetting mine on a calendar year just so I don't have to mess with it anymore.
That's what I do.
But yeah, no. I mean, you can definitely straddle years because not all of our programs left in January and came home in December. So you can straddle years and you can overlap dates as well, right? So, you know, if you claim, you know, for your first FEIE, you claimed like, you know, August to July or whatever, your next one can still be January to December. So you can kind of use the same days. It's definitely wonky and confusing, and I apologize. I wish there was a better way to explain it. But yes, you can straddle years. You can overlap. You just have to find 365 days sandwiched together where you were gone 330 of those.
You can't use two 365-day periods that overlap, though, can you? Like they have to be.
Actually, I mean, you can overlap. Mm-hmm. Yeah.
Okay.
Mm-hmm. Yeah.
Because
another important thing to note though is it's only for the time that you're outside of the United States. You know, so if you were gone 6 months out of the year, your FEIE only applies to the 6 months worth of income that you were out of the year. You don't get it for the whole year. You just get it for the time that you're outside of the United States.
Okay, that helps clarify actually for me a bit. Like that it doesn't apply then to the whole tax year. It would just apply to that window of the year. Okay.
It just applies to the time that you're outside the United States.
Okay, that helps a lot actually. And like a number of other questions that I don't think I'm going to do live, you kind of covered are all on that idea. So I would also just say, I think like you've done a really good job trying to clarify it as best you can. But for anybody else that has outstanding questions on that, like the math in terms of the calendar year and such, maybe just reach out to Pino or reach out to your tax professional if you have one that you use. Because I think you do get into the weeds kind of quickly in terms of like opening a calendar and figuring out when you were gone and all that stuff.
Oh yeah. And I saw Chelsea's question in there, so I will comment that yes, U.S. airspace time counts as being in the U.S.
And I saw Hunter had a good suggestion in the chat box of like just keeping some sort of spreadsheet. And I think you suggested this too during your knowledge job, keeping some sort of spreadsheet that tracks this stuff so that like when you get close to, you know, the end of the year, you know exactly how many days you have left in the States. I got really lucky a couple of years ago where like I was on the good side by like 1 day, but it's not like I was like that thoughtful about it. So like it's pretty easy to like get close or like, you know, lose track of the days if you're just traveling and not thinking about your FEIE. But like if you're going to save some thousands of dollars, it's probably worth having a spreadsheet to help you keep track of the stuff so you stay on the good side.
Another bonus about that, your tax accountant will love you if you keep a spreadsheet of your dates.
There we go. And then, yeah, so it looks like, all right. And then we have questions about, all right, there's just some more like ROI specific questions. I would say if anybody, yeah, maybe I'll try to chase up the answer about like how to get that itemized bill question that came through and see if I can put like a response in the Knowledge Drop Slack channel of like where to find the answer to that, because that's probably more my territory than Pino's in terms of like the ROI specific related questions.
Yeah. And I mean, the thing about that, I mean, think about, you know, every city that you go to is different in terms of what the split is going to be between travel and accommodations. The remote year they do their best to provide you with a breakdown as much as they can. So, you know, think it's difficult for them too. So I'm definitely not putting the onus on remote ear to break that down for you.
Yeah, it'd be like asking McDonald's to be like, how much is the bun and how much is the, like, it's a thing, it's like it all goes together.
Exactly.
But yeah, I think it is nice that we do like a little bit. We help you say like at least the workspace, because we know that can be 100% deductible, has this price point. So then you at least know you're safe inside of doing that.
Yeah.
And as a final question, because I think it's adorable, Marissa's asking, "Hey girl, what's up? Does Pino have more room for clients, for new clients?"
The answer is yes. I absolutely do.
Awesome.
So yeah, feel free to reach out, contact me, Slack, email. Anyways, I'm gonna have my website posted up earlier, so you got 1,000 ways to get in touch with me, and I'm always happy to chat with other remote. So don't hesitate to reach out.
Awesome. The benefits of being part of the big nation family. And thanks again for doing this, Pino. I know I just noticed we just got over time. We have even more questions coming through. So I would just say, if you guys have further questions that weren't totally clear in your mind or anything like that, reach out to Pino. She's super available, super friendly, as you can tell, and yeah, really helpful when it comes to all this stuff. So thanks for joining. Hopefully you learned a bunch in the last half an hour from her, wisdom. And yeah, feel free to share this link around. I'll post it into the Knowledge Drop blog archive and back into the Slack channel once it's all live online. But yeah, thanks again, everybody.
Yeah, thanks for listening, guys. I know tax is boring. I did my best.
Did really well, I think. Like all those little gifts and it was good. We did well. All right, ciao, everybody. Have a great day.